All right, so Neil, thank you for taking the time out of your busy schedule to sit down with me. I'm glad that finally we get to put a microphone in front of one of our conversations.
Okay.
So you've been to two of our dinners?
Been to our dinners, yeah.
Two of the dinners. So as we were talking about off camera before, this conversation is an extension of that initiative, essentially an opportunity for other members of the public leaders community that we have here to hear stories from their peers. So I wanted to talk to you today about your experience in public markets, in particular how you've seen and felt it change since you first started working public markets in 1987, is that right?
Yeah. So it all started. So I co-founded a firm of chartered surveyors, and in 1986, chartered surveyors were then able to raise external capital.
Okay.
You actually couldn't do it until 1986, when the restrictions got lifted. So we looked at the possibility of raising some external capital, number one, right? But what we also thought, that as a listed company, we could take on some of the big guys. So sort of the established firms like Knight Frank and JLL and CBRE and all these people. But we thought we might be able to sort of punch above our weight by being a listed company. Because in those days, the share price was in the Financial Times every day.
But was that because you thought you would get more credibility from being listed?
Yes,
or? Yeah.
yes. So we thought about it very carefully. But certain things haven't changed. So when we were thinking of listing, right, remember, I never had any experience of public markets. I had the faintest idea, you know, what one does. So what we did initially is we went to see a lawyer who specialised in that sort of thing. And then we were going to go on the main market. It was decided we would go on the main market. And we then, let's do it. And at the time, we actually had 3 bank accounts. We had a bank account with Barclays, NatWest, Bank of Scotland. So Barclays was our main account. Piccadilly Circus branch, big branch, very important manager. We went to see him about going public. He said, great. He said, we'll handle it. And it was called, in those days, Barclays Merchant Bank. And can you believe it? They said no, we were too small. Our manager went ballistic because to him, he possibly could lose a customer. But they didn't want to know. So we thought, let's go to NatWest. And NatWest had a division dealing with public markets called County Bank. Went to them. Oh, great. Yeah, we're going to... And then they turned it down. Too small, right? And then we went to the Bank of Scotland. And the Bank of Scotland had a division called the British Linen Bank.
Right.
It's been going since the 18th century in Edinburgh. Went to see our guy. He said, we'll take this on. And in fact, I'll get someone from British Linen to come down tomorrow from Edinburgh. And he did. And he started the business of going public. They were great. They were absolutely great. And we went to raise external money. It's lawyers, it's accountants, all that stuff which we'd never seen before. The fees, you know, we had to speculate on the fees because it might not come off, you know, and suddenly you've got abortive fees. So we had to think very carefully about doing it. And then we had to think about non-exec directors. You know, we had no non-execs. So we've been going for 16, 17 years. It was all us. Suddenly we had to bring in 2 external directors. So it was all different.
Well, let's pause on that because I want to come back to both the raising capital and board composition in a second. But zooming out a little bit, it's been 30 years since that initial process.
38.
38 years. So in that time, I'm going to rapid fire 3 questions to you now. First one, in your capacity as running a public company, what is the best piece of advice that you've received? One bit of advice.
Take advice.
Take advice. Can you expand on that?
Take advice, yes. Because even though you run public companies, you're learning all the time.
Yeah.
Right? And markets change. I mean, they change. They change from 87. I mean, we succeeded in 87. We actually pulled it off. And the reason was we wanted to do acquisitions using our shares and all that sort of thing. That's one of the advantages. But the changes now, right, is firstly, being honest about it, a lot of bigger investors only look at scale.
Yeah.
You know, if you're a smaller company, a lot of them are just not interested. So when we floated in 87, we had very few retail investors. They were nearly all institutions.
We're at sort of the inverse now.
Yeah. So we're nearly all institutions. And as small as we were, even allowing, you know, for 35 years, we pulled in institutional shareholders. But what's happened over the years is suddenly they talk about scale, suddenly you're not big enough, they talk about liquidity, which is another issue, right? And suddenly you then have to focus on investors who would normally not focus on. I mean, but you have to.
So when you say take advice, because that makes a lot of sense, like the market has changed demonstrably since 87.
Yes.
And I think that's a really good point around how for growth companies, the investor mix has sort of inverted.
Big time.
Big time. And when you say take advice, what has been the best source of advice? Or is it just as a general statement, always be learning?
I think always be learning, right? I will always learn, right? I will always talk to people, particularly, and in my last company, I was always talking to my competitors.
Yeah.
We used to talk to each other, right? And we thought it was quite important. We didn't talk to the competitors who were much bigger than us because there was no point. Their world was different to us, right? But the smaller ones, I spoke to. And it's amazing what you pick up, right? Now, in the real estate sector, the big debate has always been, why should real estate shares in the UK be valued purely based on NAV? Why aren't they valued like other companies on profit?
Right.
How much money you're making?
Right.
Which is the case in the United States. But it's not the case here, right? I think it's going to change. They keep looking at this net asset value, which I've always thought is nonsense, right? How much money are these people making, right? Because if you have net asset value, you've literally got a limit on your shares.
Yeah.
You know, and if your NAV is £1, your shares won't go above £1. They may go to 105 or something, but they're not going to go to 150.
Do you think it's laziness? Because it's just
I don't think it's laziness. I think it's like been the accepted norm, but it's wrong.
Yeah.
Right? Look at house builders, which is also in the property sector. They're on profit, right? It's only the REITs and the investment companies that are based on NAV. And I've always thought that's absolute nonsense.
Well, let's come back to that. But on this point of getting advice, I think that's a really great point because as you've observed firsthand, the market today is fundamentally different from the 90s. Yeah. And if you were to try run a public company like we're in the 90s, you did fail. And that, you know, for example, if you relied on, let's make sure we get good research and we'll get good introductions to institutional investors and then let's build it and they will come, that just doesn't work. And so that's a great realization. What about just changing tack, the worst in your 38 years running a public company, the worst piece of advice you've received?
The worst bit of advice?
Worst bit of advice.
The worst bit of advice? Well, I think there's been more than one. But the worst bit of advice is when people tell you you can't do this. Yeah. This is not going to happen. Forget it.
Can you give it like a very quick example of something you've been told you couldn't do?
Well, in my second company, I still remember, we were going to list a company on AIM.
Right.
And
is this Palace Capital?
No, this was called Mission Capital.
Okay.
And we were going to list it on AIM, and it was 2005. And if you list a cash shell today, you have to raise at least 6 million.
Yeah.
Right? But then it was 3 million. Right? And we were told by all our advisors at the time, people I know, you're totally wasting your time trying to raise £3 million because it's harder to raise 3 million than 30 million or 50 million.
Right.
It is very, very difficult, right? You're just not going to get there, right? And then life is about judgment, right? And in the end, you've got to say to yourself, are they right or are they wrong, right? And you've got to make a judgment. And when we had to raise this 3 million, right, it was quite difficult. But we did do it, right? And then when we did my last company, Palace Capital, we agreed to buy this portfolio with nearly £40 million. We were a £500,000 market cap public company, and we're out there raising nearly 40 million. So we had to raise 20 million of debt and over 20 million of equity, right? I cannot tell you the number of people said we're wasting our time, right? And you have to decide, is that bad advice, right? Or are they just going along with the flow? And our view was, it was plain bad advice. They didn't research it. They just gave an off-the-cuff opinion, you're wasting your time. And what happened was, our broker at the time, you won't believe it, actually went broke.
Right.
Right. And we had to find a new broker.
Yeah.
So we had to find a new broker. We'd agreed a deal. We had to raise over £20 million, and we've got to see a new broker who didn't know us, madam. Right? And you're talking 2013 or something. And we went to see 8 brokers. 6 turned us down absolutely flat. You're wasting your time. There is no demand for this. And we still remember, my partner and I remember, one broker said to me, Neil, what are you smoking? He actually said it to me, right? And I said, you're wrong. So we then had 2 brokers left. One couldn't agree amongst themselves.
Right.
But in life, however clever you are, you need a bit of luck.
Yeah.
Right? If you haven't got any luck, I'm going to tell you, you're in trouble. And the 8th broker said, I've got to tell you, we've got an office in Birmingham. And he said, we've noticed a definite pickup. So he said...
And for context, that was because Palace was looking at properties...
In the regions.
In the regions, yeah.
And he said, we think we can raise the money. Right? Now, we're a £500,000 public company. We have to raise 23.5 million. We've got the debt. We took over we used the same lender as the vendor did.
Right.
So we got the debt, £20 million, and we had to raise 23.5 million. Right? But this is where you need good people, you see. So we had to raise 23.5 million, and they said it'll take 2 weeks. Right. On the first day, we raised 7.
Not bad.
We thought, wow, this is easy. And then, by God, it got difficult. Too small. Many said it was too small. And the second problem was, because it was regional property, and you're talking Manchester, you're talking Leeds, you're talking Birmingham, you are seeing fund managers in London, the bulk of whom have never been there, right? They just never go north of the M25. They might go west to Cornwall and might go south to Brighton. And might even go east to Southend. But they don't go north, you know, like off limits. And that was a major issue. So we had 3 weeks to raise the money. 23.5 million. After 2 weeks, which was the allocated time, we only had 15. Now what we're going to do, you know? But we were convinced we were right. You know, we're going to get the money. So, and the broker said, you've got another week to raise the money, otherwise we've got a problem. On the following Friday, we had 21 million. We had 2.5 million to go, and we had to until 4:30.
Wow.
By 10 o'clock, we got another 500,000. So we're 2 million short at 10 o'clock. Now, this is to the wire, isn't it? Right? And this is where judgment comes in. We believed we were going to get there, right? And my partner at the time, he said, I've got an idea. And he rung this private equity group in the West End. He said, we've got a meeting in an hour. Met them. They didn't invest in public companies. It was totally not their business.
Right.
But they knew my partner well for 30 years. And can you believe it? They put the 2 million in.
Yeah.
And we got the money. And then what happened? In the afternoon, 3 or 4 institutions phoned up. Right, we're coming in.
Right.
And they had to be told they were too late.
Well, everyone's happy to take the risk once it's already a done deal.
Yeah, but they didn't expect it. They thought they were, it was a bit silly, really. So we actually got the money. So the advice we had from the broker, he was right, right? That he said, I think we can raise the money. The only bit he got wrong took 3 weeks rather than 2, but okay.
So, well, that's a great story and 2 interesting threads to pull together. That because you said the best advice is take advice and keep learning.
Yeah.
But then on the flip side, don't just, if I could recharacterize what you're saying, don't just blindly believe every bit of advice you're receiving.
Don't.
And the reason you're running the company and not being an advisor is because you have the ability to pass that information and make a judgment call. That's what you're there for.
It's
and
all
so
about
trust that.
It's all about judgments. Now you know, right, that in the listed sector, CEOs make errors.
Everyone makes
Some
mistakes.
of them pay the ultimate price, don't they? I mean, this is what happens. They make errors, but you don't get it right all the time, but you want to get it right most of the time.
Well, let's fast forward. Current company, Pristine Capital, you're essentially trying to do it again.
Yeah.
You've got, as of the date of this recording, there's a transaction you're working on.
Yeah.
This has already been disclosed to the market.
Yeah. Well, the actual deal hasn't.
The deal hasn't, but
No.
the fact that there is a deal,
Yeah.
now working on pulling it all together.
Yeah.
So going through this process again now,
Yes.
in 2025, could you give me just 3 dot points? What are the key things that are different now? Or because you talk about the benefit of experience and good advice. If someone else was about to start doing what you're doing now,
Yes.
what are 3 things you'd tell them as advice?
Well, it's all about timing,
Yeah.
right? And where you have to be careful is if you are a bit early, where you know what is happening in your sector, which can only get better, but you're dealing with investors who are not in property, and they may not get it.
And that could be applied to any industry. There might be. Yeah.
They may not get it, and that, in the current presentations, some of the people I've met, they still think the bulk of the country is working at home.
Yeah.
They're not. What are they doing? They're in the newspapers, and that is an issue, right? The other thing is, I mean, we're doing a fundraiser at the moment. It's not a brilliant time. It's July and August, it's not exactly, but the only good thing about it is people don't go away for 4 weeks. They go away for 2 maybe.
Right.
So you do catch them, but sometimes you can't see them right away because they're on a beach in Mallorca, but that's the way it is, but as far as that we're concerned at the moment, right, what you have to get right in our sector is you've got to get the debt right. Everyone's very conscious of debt, particularly at the moment. And you make your money going in. You don't make your money coming out. Some people think, well, you make money coming out. You don't. It's what you paid for it in the first place. I mean, that's where the money is. And that's where you have to focus, and that's what you have to sell. Right? Now, we're trying to sell a particular transaction at the moment, and we have to we're saying to them, we haven't come to you before because no deal that we've been offered has been compelling enough.
Right.
Right? And we think the first transaction that we have to do has to be better than anything. Right? Your second is quite different. Suddenly you're established. It's not quite the same. Right? But your initial transaction has to be compelling, where you're hoping investors say, well, I can't afford to miss this one. Right? That's, to me, is what's important.
So last time we caught up, you were talking me through how you were approaching the sort of roadshow process, and something that struck me was how much of it you were doing yourself.
Yep.
And in particular, how much of it was still fundamentally based on relationship, which I think is something that can be lost these days.
Yeah, it is.
And in particular, you shared an anecdote with me that when you, and correct me if I'm misremembering this, when you started the process, you found a list of your existing shareholders and you started calling them up, just yourself, and essentially raising money from them directly. And you'd found that was quite easy and successful, and probably more so than going down a more established route.
The only problem, because we're a cash shell,
Yeah.
you can have a 10% of our company. It's not a lot of money. You
Yeah.
know, so, but we have to raise quite a significant amount of money. So we have to ring non-shareholders. So what I've been doing as a cash shell in the past 6 to 9 months is raising awareness of the company.
How have you been doing that?
So we did a webinar from the London Stock Exchange.
Yeah.
Now they rang me up out the blue and said, we're just launching this new project. Would you like to do a webinar? And I really thought they were joking, because it was a London Stock Exchange. What are they ringing me for? You know, I'm a cash shell. And they said, no. You know, you're quoted. As far as we're concerned, you know, you're the same as anybody. And we took it on, and I asked them whether we could have the webinar at the London Stock Exchange. And they said, that's fine. So we did that, and it was quite interesting. I would say for a week, there was very heavy trading in our shares. Of all the webinars we've done, there's no question they're the most successful, was theirs. And I think it's because the London Stock Exchange Group is a data company. It's not, you know, the exchange is 3% of their business. They bought this huge data company called Refinitiv off Reuters, and they've got a huge database. And it was quite incredible. For about a week, there was very heavy trading in our shares, you know. And then we did another one with a very big platform called AJ Bell. But that wasn't a webinar, that was personal. And they hold them every month or couple of months, raising awareness amongst investors. So when we came to do our deal, I didn't want a situation when people said, Pristine Capital, never heard of them. So we spent 6 months really raising awareness all the time. And I was doing all these webinars and all this sort of stuff, you know, and that's what we've been doing, you know. And I mean, it's quite interesting looking at the cash shells, to be quite honest. Most of them are in the resource area,
Yeah.
you know, most of them.
Which is a different type of investor and risk profile as well.
But the risk profiles, some of the risks I don't quite get, I've got to tell you, you know, they've got a mine in some obscure place, and you think, you know, have they?
Yeah.
You know, so, but yeah, so that's really what we've been doing. And it was quite interesting. It was then before our shares got suspended because of this transaction, about 2 months ago, I think, we had 62 trades in our shares on one day. And we couldn't believe what was going on. I mean, our shares went up about 40% in a day. I mean, I know it's all, you know, penny stock stuff.
Right.
But huge amount of trading. And I don't know, and we still don't know what that was all about. You know, because we never said anything or did anything, and nothing's a bit in the press at all. But that's what happens in this small cap market, you know. So
Would you say on aggregate it's, in terms of the process, harder to run the process to raise money now versus in previous times?
Yes.
But just because of the macro environment, or also
I
just...
think it's several. I think it's several things. I mean, the stock exchange until recently was pretty depressed.
Yeah.
There's still this nonsense about paying stamp duty on shares.
Yeah.
You know, it's actually ridiculous. But the government is so short of money. I mean, there's no way they're going to get rid of that. Fact of life. America, there's no stamp duty, and if you buy US shares, there's no stamp duty. So the whole thing is absolutely nonsense. So we got that to put up with. But the stock market was pretty depressed for quite some time. But as you can see now, the London market has picked up quite a lot. And if you saw in yesterday's newspaper, there is a lot of it is some US investors who are buying into our stock market rather than America, which must mean they think America's two things: tariffs, and maybe it's too high.
Will they just see some bargains?
Well, there are bargains. You know, there are bargains, but getting down to my sector, right? My sector is getting reduced because there's been this big call for consolidation in our sector, which is all very nice. But the problem is, if there's not many companies left, you haven't really got a sector that is of any interest, really. You know, and it needs more IPOs within the real estate sector. Needs them.
So if there are other public leaders listening, maybe they're in property, maybe they're in another sector, and they're about to go through a process of listing or raising capital, things that you're doing now and have done in the past, you started this conversation by saying that one of the big changes that you've noticed is that the focus has moved, particularly at the smaller end, away from institutional investors towards individuals, high net worths. How would you suggest other public leaders address that?
Well, it depends on their size, right?
Let's say they're a smaller company.
So if they're a smaller company, right, they must raise awareness.
Yeah.
Right? It's absolutely critical. You know, you sometimes see these smaller companies suddenly make an announcement. You think, you've never heard of them. You know, you need your profile.
So raise awareness, but what next? Because obviously awareness is one thing, but if everyone knows it, it's sort of like putting up a billboard. If you put up a billboard and say, come buy my stuff, and then do nothing else, you've got awareness, but that's not going to convert to anything.
Well, you've got to do something.
What about the next steps? How do we convert the awareness?
Well, you've got to do a deal. I mean, you know, the fact that if you want to raise capital in the public markets, right, you do one or two things. You're either making an acquisition and you want to raise the money to do it, or you're raising the money initially, a little bit of a war chest sort of thing, and then you make an acquisition. But I've always found that quite difficult. People don't like giving war chests. You know, they went on the back of a deal. Now, in my sector, that's difficult because we can agree to buy a portfolio or something, and then the broker will say, right, I can raise the money on this, but that can be 6 months. You know, is your vendor going to wait 6 months? You know, which is a bit of an issue. You know, so there's not many transactions around where you can do that, right? The great thing about the public markets, which we haven't discussed today, but one of the reasons we're in the public market is we want to use our shares to buy other companies. So I did it in my last company, and we expanded the equity by issuing shares to buy assets or buy companies. And within the real estate sector, that is now happening. Different scale. There was a recent merger of, well, I think it's going to happen, Primary Health and Assura, where some of the payment is going to be in paper, right? But that's not the only one. Another one called Custodian REIT, they've just done another issue of shares to buy a company. So the one thing that the private markets cannot do is issue shares to buy companies.
And that works so long as you can ensure that the paper is valued correctly.
Correct.
And so if there isn't enough liquidity, and to your point earlier, a lot of that liquidity for companies that aren't huge, so outside the indices, is not going to come from institutions. So as long as you have enough investors and enough of a market that is valuing it correctly, then you can use the paper.
You can use the paper, but then the other issue is, will the vendors take your paper, right? And some of them are considering taking paper now because of capital gains tax. So if you take paper, you don't pay the capital gain on taking the shares. You only pay the capital gain when you sell those shares. So that is one of the reasons why people do take paper, right? And it does work. The other reason in my sector is that if you become a real estate investment trust, right, if you are, and in my last company we were, you can buy companies with inherent gains. So if you've got a private company, as an example, that's worth 20 million, but their properties were bought for 10, there's an inherent gain of 10 million there. So if those people sell their shares for cash, they'll pay capital gains tax.
Right.
If they sell the shares to a real estate investment trust, they take the shares and the real estate investment trust wipes out the gain. So there's a great advantage in becoming a real estate investment trust, shortened version called a REIT.
Right.
Right. They're very big in America, and they're quite significant here, right? Because there are advantages, and we see the advantages of using shares to buy other companies, and we're finding that vendors are increasingly receptive to that. Not necessarily all the price, but certainly some of it.
Yeah, okay.
And we think that's one of the attractions of being in the public market.
Well, there you go. I mean, we could talk about that for a while, but one final thing
Yep.
to leave people with. If you were to predict into the future, and so 5-10 years' time, think broader than just property, anyone that runs a public company who's in your position, what is a skill that will be very important for someone running a public company to have in 5 or 10 years' time that might not be as important now or at the forefront?
I think we have to embrace AI.
Yeah.
Right? I think we're already embracing it. That's already having an effect in our industry. There's no question about it. And people have to be tech savvy.
So from a public company perspective, what does that look like?
Even as a public company. Even as a public company, you've got to be tech savvy, right? Using artificial intelligence, because as far as I can see, in my sector, right? Yes, you've got to be tech savvy. Yes, you've got AI. But at the end of the day, right, when you're public and you're going to buy other companies, it's still your judgment. You know, you can put it into AI, but it's still your judgment. And it is to this day, you know, where we get analysts who tell us about things in my sector, right? Fine. But they're analysts. They don't really understand and see what we see. So when I look in my sector, and when we were dealing with regional property, I looked at all the regional cities. I examined all the regional cities. Where did I think the growth was going to come from? Right? Where could I make the money? Right? And it became pretty clear, right, what cities were going to see particular growth. And in my sector, you've seen huge growth in Manchester. Now, why would you get growth in Manchester? People say it rains all the time. Who's going to Manchester? The fact is that 60% of students at University of Manchester stay in Manchester, even if they live in London, right? Because they can rent or buy an apartment much cheaper than they can. Secondly, the jobs are there, right? Now, 15, 20 years ago, the jobs were not there,
Right.
right? But they are now. You then had a local authority run by a guy who was determined to rebuild Manchester after the IRA bomb in the 90s. And they've succeeded. And you go to Manchester now, you can't believe what you see there. There's been huge growth, and we saw it in my last company. And we bought a building because we could see it coming, right? Leeds is another one, right? Is another one, right? It's like Manchester's got mass transit. Leeds is now probably the second largest financial centre in the UK. Very important. So we saw all this, right? But I'm saying to people who run listed companies, right, if you've got a vision and you can see where the money can be made, do it. Rely on your tech, rely on AI to some extent, but at the end of the day, it's your own judgment.
Trust your judgment.
It's trust and judgment. I mean, just as an aside, you probably followed it, but looking at Rolls-Royce today, you know, it's been the most phenomenal growth in 2 or 3 years. It's been absolutely incredible. But the CEO is a dynamic guy, you know, and he knew what he had to do,
right?
And he's done it,
you
know. So it's judgment.
All right, trust your judgment. I like that message.
Trust your judgment, and don't listen to people who tell you they know what you're talking about.
Trust your judgment, the title of this episode. All right, thank you, Neil. It was great to sit down with you.